Welcome, Greg.
Thank you so much for having me here today. As you heard in the introduction, my name is Greg Hall. I'm a managing director at PIMCO. I've been at the firm for about 5 years, prior to which I spent a dozen years at the Blackstone Group. When we talk about our secular outlook for the economy, for markets, we tend to mean a 3 to 5 year time horizon. And we distinguish it from what we refer to as our cyclical outlook. And our cyclical outlook is something that we develop much more on a 6 to 9 month basis. The product range is concentrated in fixed income. That's of course what we are known for. But I wanted to point out to you that when we look at markets increasingly, we see across both traditional and alternative investment strategies. We look at public markets and private markets. Our view is that most risk factors in investing are similar across these different expressions of investments, that investing in private strategies, investing in public strategies, the baseline is still an understanding of the global economy, of a political situation, of a sector in which a company is operating, of the specific inputs and outputs of that company, whether you originate the deal privately or originate the deal by purchasing its securities in the public markets. A lot of the inputs are still the same, and it behooves us to be active in both markets so that we can identify opportunities that maybe fall between the cracks, or arbitrages that potentially reveal themselves by looking at both types of strategy. And then finally, not to gild the lily, but I did want to return to our alternatives business and just emphasize the point to you that when I speak about markets, I speak about risk factors. You'll often hear me talk about fixed income. You'll often hear me talk about the bond market. However, increasingly, when we talk about credit, we mean both public and private. When we talk about real estate, we mean both public and private. We have been systematically building out our private markets operations across many of the asset classes that we are active in on the public side. Today, the business is about $140 billion in AUM. It divides between our opportunistic platform, our private lending platform, our CRE business, much of which came over when we absorbed Allianz Real Estate's core private equity real estate business. And we have a significant alternative credit business as well. We're active in performing lending, we're active in distressed credit, we're active in private equity on the real estate side, very active in special situations as well. So the secular outlook that we put out in June of this year, we titled it Reaching for Resilience. And the meaning of that statement was really a play on what we thought had been happening over the previous decade plus, which was a reach for yield or a reach for return. It was investors doing more and more and more to identify an extra basis point, an extra percent of return in a world where monetary policies and other factors had pushed spreads and rates as close to zero, if not below zero, as they possibly could. And so there was this phenomenon of taking liquidity risk or credit risk or other forms of risk in order to achieve levels of return. And in discussing this earlier this year, the conclusion of the group was that we were in a different environment where, for a whole number of reasons, really driven at first by the pandemic and subsequently by the Ukraine invasion, that not just investors, but countries, regions, companies would begin to emphasize resilience, redundancy, the ability to withstand shocks as a primary motivating factor. And so instead of being risk-seeking and reaching for return, they would reach for resilience. They would be willing to spend and to undergo lower returns in an effort to achieve resiliency in their portfolios and in their supply chains. And so that's part of the overall thesis here, is moving from a global economy that was razor-focused on integration and efficiency and driving costs to the absolute minimum possible, to a global economy that recognized that supply chain disruptions were not clearing themselves very quickly, that geopolitical risks had mounted, and that global actors needed to be more cognizant of the potential for disruption and invest in insurance against that. And so what does that mean for global markets? Well, first of all, you have this pulling away from globalization, enhanced regionalization of end markets and capital markets, which means that you could see more divergence across the global economy in terms of outcomes, which I think we're seeing actually over the course of this year, and there's examples of that which no doubt you could come up with quite readily. The volatility and inflation, or I'll get to inflation in a second, but just the volatility and outcomes is picking up as the synchronization of global economies ebbs, the potential for different outcomes increases, and this isn't just in markets, but you see it nationally as well. One of the conclusions we had from the secular outlook was that the defense industry would be a net beneficiary of this new world order that we're discussing, that countries would see a need to invest more heavily into defense given the heightened geopolitical risk and a slackening of global alliances to protect them. We predicted that there would be an elevated risk of recession over the next 2 years. This was back in May, June of this year. Today, that recession viewpoint on our part is the base case, actually. We think there will be a recession in 2023. That's our base case view. We don't think it'll be a particularly deep recession, but we think it risks being quite a prolonged recession. Again, that's a base case view. We have to approach this with humility, and of course there's a tail that would have a deeper and harder recession. There's a tail that would actually see us have a soft landing. We think the soft landing prediction is increasingly less likely to occur, and certainly history is not on the side of the soft landing. So what does an investor do, in this circumstance and given this outlook? We think investors also should reach for resilience. When constructing a portfolio, optimize for the ability to withstand shocks, the ability to retain liquidity, the ability to change your mind and make new decisions as things unfold, the ability to have more safety and quality in the portfolio, potentially at the expense of return. But given what we're predicting and what we think the world will do over the course of the next 3 to 5 years, we think that is the smart bet, and then ultimately the return maximizing strategy by keeping your options open over time. And then maybe a little bit self-servingly, we think fixed income will play a more important role in portfolios than it has over the most recent past. And particularly today, given the value that's emerged in fixed income, we think that investments in high-quality fixed income today are a suitable replacement for equity investments. They're competitive relative to cash, and we think they're should be a meaningful part of an investor's portfolio as you're trying to create this resilient posture in your own asset allocation. Real GDP has come down quite precipitously, and we think we'll move into the negative part of the chart in the early part of next year, whereas inflation has been not just quite high, but persistently so. And in all honesty, it's stayed at these high levels longer than we had predicted, going back a year or so, and there's a lot of stickiness in underlying prices. We do think inflation will come down. We do think that in these numbers there are some inputs that are idiosyncratic that relate to COVID supply chains that will roll off as we get further and further away from that phenomenon. But we've revised our views, in the most recent period to think that we may not, come straight down to target rates of about 2%, but may hang out in that 4.5%. I've discussed a little bit our views on the recessionary outlook. I'll elaborate a little bit, and I'll speak a little bit from a U.S.-centric perspective. But we, in our cyclical outlook released today, which we call Prevailing Under Pressure, we changed recession from a heightened risk to our baseline expectation. And we don't necessarily think that a recession needs to be a catastrophic event for investors, for the economy. Our assessment of the base case is that we could have a relatively shallow recession. The initial conditions in the U.S. economy and many developed economies around the world are reasonably strong. U.S. household debt is at a relatively modest level compared to prior recessionary times. Corporate debt, as I mentioned before, has been managed quite well and quite rationally and is not extreme. The banking sector is relatively strong, owing quite a bit probably to some of the regulation that was put in place after the financial crisis. But we have noted, and as you probably have too, that despite the tightening financial conditions and all of the volatility we've seen in markets over the past several years, what you haven't read in the newspaper is about a large global multinational bank failing. And so that system seems to us to be relatively more robust than it has been in previous cycles. And so for all of those reasons, we think that a recession, if it occurs in 2023, will likely be relatively shallow. It's an interesting thing to think about opportunities in that environment. We do think there are some weaker parts of markets in the economy that even a light recession might expose and create some really interesting opportunities. Generally, though, when we think about opportunities in fixed income, especially considering the starting yields that you see in the market today, even under that recessionary base case, we're quite excited about the value that exists in fixed income right now. The last thing I wanted to say is a topic that we've debated a lot in our recent forum meetings, and that is the differences and similarities between public and private credit. And I'm going to speak about credit specifically here because it's got the closest analogs. I think never before has the market for privately originated credit been this big. It's in many ways it's replaced the syndicated bank loan market. It's bitten into the high yield market, and there's lots of good reasons for that. Privately originated credit can be flexible, it can be fast, it can be assured of the deal going through and the transaction happening, the loan happening to support the transaction. On the other hand, there seems to be a little bit of a belief that because these loans are made privately and they're held in vehicles where the mark-to-market practice is on a lag and a little bit more mark-to-model than mark-to-market, and certainly not built on transactions that are occurring in the public market, that they are different than the public credit markets. And we would just argue that in actuality, private credit has tended to lend to small, medium-sized businesses going through transitions. It's been predominantly floating rate, which feels good to the end investor because you're taking away your rate risk. But remember, if you're the company who borrowed $200 million on a floating rate basis and rates have gone up as much as they have in the last year, your cost structure has just expanded pretty precipitously. And so in effect, you've got smaller, lower rated corporate borrowers with a levered corporate structure and higher debt coupons to pay. We find a lot more value in the public market today than we do in the private market. And in fact, on the credit side, a lot of our interest lies in distressed and stressed type lending as we prepare for potential opportunities that will arise from some of the private market excesses that have happened. So I just want to plant that seed in your heads that credit risk is credit risk. You can evaluate it. The way that it's originated has an impact on the structure of the security, but it's not the only factor that matters. And we think you can actually create really, really attractive profiles in public markets today that are superior to what you can create in private markets. That will change, and we're excited for that opportunity to emerge in coming years, but that's certainly our present view, our cyclical view, if you will. And with that, I'm gonna leave it here and pause for questions if you have any.